Good morning, everyone. My name is Josip Causic. Today is March 28, 2023. While waiting, I hope you had a chance to install the SpeakUp app and type in the room number 28691. That's a private room. You would be able to interact with me. If you have done that, I highly suggest you send me a text here so I can see that you're in and that you hear me. So, we are not financial advisors. We are here to look at what the market is doing and provide educational and instructional services. Um, Please take a moment to read the disclaimer. If you need to get in touch with me, the email is provided right here. I'm going to just point out to you that this is the email where you can get in touch with us um, at tradactive.com. And agenda for today is sounds good. Thank you very much for confirming it. Is following. We are going to have a big picture view of the monthly charts. Thank you again for confirming it. Appreciate that. Um, it's very important for us to know what the market is doing on monthly basis rather than always just look at what's the market doing on a smaller time frame. For instance, on a smaller time frame, market right now doesn't know which way to go. These are the 10-minute bars on the FinViz, and you would see over the last 30 minutes, because each bar is 10 minutes, you have a candles almost the same size body, green to the upside, red to the downside, green to the upside. So this is like a total utter confusion. So it's really appropriate for us to actually start with the monthly first. And then once we have a big picture of the monthly, thank you once again for confirming over here. So I have like 4 or 5 people already typed in. Hi, Jeff. Good to see you. We're going to then look at the 4 major markets, 4 major sectors, and I want to jump into individual trades, right? Um, so what I'm going to do now is pull up our platform here, and on our platform, I already have open the Dow Jones Industrial Average. Dow Jones Industrial Average is being tracked by the Diamonds, which is an ETF. And when you look at right here, what you would notice that I'm using the monthly uh, bars. So each of these represents a month. Now, of course, this month didn't close yet because we still have this week of trading. But in comparison, where the price action is versus where it started, we are down for a month. We are down for a year, but the year is not over, but we are down for a quarter. Now, the one thing that I like to use as a real measurement of what is a line in the sand was the February 24th of the 2022 low, because that was a significant day in the history of the world, because that's where that war with the Ukraine started. And you will notice that for a long period of time, that level was acting as a level of the resistance and a support. So every single time when it came to there, it was kind of bouncing around. And currently, we are slightly above on the Dow Jones of that significant February of the last year when the war started. Now, it's important that I use the same kind of measurement for every one of these markets, because when I go now to the SPY, obviously you're going to see right here now I'm looking at the SPY. I'm still looking at the monthly. I'm still looking at what is called in Japanese doji, or indecision, when you have a high and low and open and high virtually at the same place. And then you're realizing that on a SPY or a S&P 500, we are slightly from where we opened December 31st last year to now, we're slightly up. But when you are watching what really happened in 2022 in February, it's interesting how to the penny, and let me just erase this so you would actually see it, that it was to the penny that we rallied up to that February when the war started, and we weren't able to go above it. This is not coincidence that the market was trying so hard in March to break above that level in order to go higher, but there was a huge amount of UFOs, those unfilled orders on the sell side, that they pushed the market to the downside. So now we are really stuck here below the February 24th of the previous year, 2022, unable to go up. So I'm going to move on and look at how bad that looks actually on Russell. Russell 2000, as I explained in my last session, and I have actually put in a chat box. You can see here the YouTube video of my last session, which coincidentally was exactly a month ago, that I explained what the Russell is composed of, small caps, and how it gets rebalanced. You can listen to that in your leisure. And I want to now compare again that particular February, and you would notice in terms of that particular February where we are. And it's kind of disheartening because obviously we are down for this year. We are down for this year. But when it comes to where we were that last February, it's really pointing out to you that we are way, way, way below. So this is the low of the February. And if I now just simply draw the yellow line, you would see that Russell is the leader to the downside. Now you might be wondering, but what is this blue line right here that you have? That blue line is not visible unless I go all the way to the March of the 2020, because the March of the 2020 right here that you can see. Thank you for interacting with me. I'm glad that you are all here. Is where the Feds decided to step in and the Feds decided to start pumping money in, and then we ripped to the upside. Well, when you collect those lows and higher lows over here that we had last year, you would see that this third touch that just took place this particular month is what is holding Russell in a still somewhat uptrend. So somebody can make an argument, oh, okay, it came to the third touch, maybe it's going to break to the downside. But I also could make an argument it came to that area, and it could also possibly, it can possibly move to the what? To the upside. So it's very important for us to understand the context in which this chop on a daily is taking place, that the sellers are trying to push it lower, but the buyers are always stepping in and defending what kind of level? Well, the level that we are watching right here on the Russell, that is a long-term 3-year trend. So having now explained what really happened in Dow Jones Industrial Average, in the S&P, and also in Russell 5,000, which is really like a hidden product. And I say hidden product because when you look at over here, you know that there's agenda. You are getting this for free. This is a FinViz free Dow Jones, NASDAQ, and S&P. And my question is, then where's Russell? Well, Russell is not being shown. They can come up with all sorts of arguments saying, well, Russell is not really important. It's a small caps. It's not a large capitalization. You would need to go under the futures to actually see the Russell. And over here, you're seeing the Russell in the futures. I'm going to just circle this in yellow as a completely unchanged because it doesn't know which way to go. So, of course, over here we have a Dow. We have a S&P. I didn't discuss yet NASDAQ, but notice the NASDAQ is solid red. So let me now jump on a monthly and show you on a monthly what is happening with the QQQ, which is a virtual representation of the same thing, of the NASDAQ 100, right? So we have a low here that I was just referring to a minute ago of the March of the 2020. And by the way, this number 20, it's always in the middle of the year because as you can see over here, this is where the December is, and this is where the December is. So when you see those numbers, the way how TradeActive platform is working, they show it right in the middle. It's not that the end of the year, but it's at the middle, right? So over here you have a 2020, as you can see, 2022 and 2023 here. And we have a one touch on the March. And then over here in September, when everybody was expecting market's gonna go lower, it did. And in October, everybody's like, oh, everything is gonna collapse. In October, the month that traditionally is known as a bearish month, we actually ended up last year having a green bar. We even went higher in in November. Now December we came right back down, and we had the what, third touch. So to consider something as a valid trend line, we need to have a minimum of the three touches. Otherwise, you can be putting the dots on any two random points. So obviously over here we have a second touch. It was confirmed then in the November of the last year that that's a valid trend line. And guess what happened in January of this year? The seller stepped in. They tried to push it lower. And again, this trend line on the longer term has held, and we had bounced off it. So this QQQ looks quite different from the way how the Russell looks. So why am I spending time on this monthly review to talk about these broad market kind of correlation? The reason why I'm spending it, because not all the answers are on the same chart. You would need to look at the multiple charts in order to realize that the Russell is now confirming inability of the sellers to push it lower, while QQQ, as you can see, is the strongest of them all on a bigger time frame. Never mind that today Nasdaq is weak. Would you agree that the Nasdaq today is the weakest of the bunch? Well, yeah, I mean that's a that's an obvious thing, but I still want to interact with you and make sure that you type that in the box. I say, okay, all is good. I see what you're pointing out. So it's misleading to look at the 1 day action and to say like, oh, look, on a 10 minutes, I see that the Nasdaq is the only one that is down basically 0.66%, while the S&P is just about ready to go positive. Dow is positive. Yeah, but what about context? Thank you for confirming it. I'm glad that you're seeing the point that I'm trying to lay down, because it's a big picture that matters, because it gives a context of what is really happening. So I'm going to now revisit again QQQ, because on a QQQ, I did not yet point out what happened here in February. So in February, as you can see over here, we have created the low. And let me again use the yellow line to mark that. In March of the last year, we tried to bounce off that low. In April, we pierced through that low. And I remember I was teaching a session back then, and I said, once when that's lost, that is going to ask no longer like a support, it's going to act like a resistance. And what happened then in May, in June, in July? Take a look. In July, it appeared that we're going to break above it. But where do we park ourselves? Right on it. But you don't get that from CNBC or from all the television. Hi, Mark. Good to see you. I know Speak Up is a little bit hustle when you log in, but now that you're in, you can interact directly with me in real time, and it's anonymous. It's not like that anybody can see it. So we broke above it temporarily in August, and then we fell. And then when we tried to again go higher, guess what happened? Again, we fell. Now look, I'm going to remove all these things, and I'm going to just draw the line in the sand. And this is where usually students get this epiphany moment and say, like, well, it's still holding the truth. The February of the last year is when this significant landmark was formed, and this is still acting as a what? As a resistance on a Nasdaq that is trying to go up. And I know this is like globally connected with the war in Ukraine and Russia, but once when the Nasdaq take this thing up, I can't say all it's up for grabs. We are going higher, because we do have a long way to go, all the way to the previous high, which is coincidentally this round number 400 on on a QQQ, which is ETF that tracks Nasdaq. But be aware of it right now. If we are unable to break higher because of the geopolitical reason, plus the Feds are raising the interest rate, you really need to be aware of that. So having said that, I just want to kind of like take a snapshot of this, put it into the bigger picture, and just kind of have this thing clear to what I'm doing. So this morning I said we're going to start with the bigger picture. I just took a snapshot of what I was talking to you for basically whatever is that 10-15 minutes, using the yellow line, pointing out to you that the Dow is currently above that line in the sand. Nasdaq is below it. Russell is way below it. In fact, Russell is ready to pick that long-term uptrend, but sellers do not have an upper hand. Buyers are stepping in, and that's why we have this little tail on the bottom. As you can see right here, let me just point out to you, there's a little tail that is being formed. That's the inability of the sellers to push the Russell 2000 lower to the previous year low. While the S&P is doing only whatever the sectors are doing. Whatever the sectors are doing, that's what the S&P is doing. Okay, so the next topic that I'm going to move on is what the sectors are doing. Now, of course, the sectors can be visible to us on a FinViz because you have this big box of the sectors. And not surprisingly, from all the sectors that we have, the ones that are predominantly, I'm going to use the blue, it's going to be a little bit easier for you to recognize, that today is down is technology. Technology is down, and this whole box is red. This whole box is showing weakness, and that weakness is causing the Nasdaq to be down. But we have other sectors that are doing good. For instance, energy sector is doing good. Well, it's kind of not going down, for lack of the better words. Industrials are still green. Utilities are green. But these sectors don't have a same amount of weight, or let's say this particular sector. This particular sector, let's say it represents like huge percent, like almost like 20% overall what the market is doing. So what I'm planning to do next is very simple. I'm going to go to the monthlies, and when I go to the monthlies, I'm going to just alter the monthlies with the four sectors. The first sector I'm going to look at is XLK. And when I'm looking at XLK, I really don't want to spend too much time talking about it because you already understand that this is last January, this is last February. And what is it happening right now? XLK is a technology sector and it's currently above it. Keep that in mind. Moving on to the next largest sector, which is a healthcare, XLV. Same approach. I'm looking at a January low and a February low, which was slightly lower than a January low. And where are we right now? On XLK, we're not losing that February of 2022 low. We're above it. So the healthcare and technology are the two sectors that are above that line in the sand. So let's move on now to the next one. And I'm going to jump here to the next one, which is going to be the financial sector, because the financial sector has been in the news so much lately that I think it's very important for us to disclose it, what is really happening with the financial sector. I don't know why is this thing not loading it up. Let's type it in right here, XLF. It should load it up here in a moment. There it is. I don't know why over here it didn't. And last month was a terrible month for U.S. banks. A lot of them have collapsed, Signature being one of them, Silicon Valley Bank being another one. There's a rumor that a lot more are coming, but Feds are stepping in. That remains to be seen. But we just need to look at the facts. Oh, look, coincidentally, in February when we rallied to the penny, we touched that. In January when we rallied to the penny, we touched that area right here that coincides with what happened in the last February right here. And then we what? Collapse. Again, without spending too much more time elaborating on these things, I'm going to now just show you in terms of the sectors what the sectors are doing. So the sectors with the fine little line are pointing out XLK is above, XLV is above, but the financials are below, and the one that didn't come up was a communication, and communication is below. So now if you need to make a decision, two are up, two are down, so it's a 50-50. It's a complete indecision of what the market is doing, which is actually justifying the reason why we actually don't know where the market wants to go. Look how huge this red bar was to the downside. This red bar this morning was very big to the downside. And then it created the basically support, and it was lining up candles of the same size body. And it doesn't matter on what, on the Dow here, or was it on a NASDAQ? And then it had what Peter Navarro, who is a professor at the University of Irvine and always talk about the different shapes of recovery, it had a U-shaped recovery. This one bar, it took three of these 10-minute bars, 30 minutes. It took 30 minutes to negate the sellers to the downside. Now, could it be now we're straight up? Well, that's where we're going to actually start talking about the individual trades, because the third part of this um, assessment was to talk about the individual trades. So is everybody good with that? I'm done talking about the sectors. I'm done talking about what the major broad market is doing, such as Dow Jones Industrial Average, S&P. Thank you for typing that all good. So we're ready to move to the individual trade. So here's the thing. The most liquid of all the products out there is actually S&P 500. So S&P 500 deserves to have an extra evaluation. And when we're looking at the S&P 100, I'm having here 55 minutes because I want to point out to you there is a huge level of what? Red unfilled orders to the top, and down here is a huge level of the buyer orders that is unfilled. So let's throw the iron condor. I don't feel very much comfortable with placing the iron condor, or maybe I can place the bear call spread and see how the things go and add a bull put spread to it. But as of now, I really don't feel comfortable placing the bullish bets on it, because we are one news away, one broadcast news, we're away from complete collapse. Whatever, the war escalated, or another bank collapse, or any of that. Thank you for interacting with me. I really appreciate that. So what I'm going to do right now, I'm going to actually start looking at the SPX options that are expiring today, and I will use the volume to decide which bear call spread I would like to sell. And when I look at over here on a call side, I always look at the volume, because the volume is for me very, very revealing in terms of what I want to see. So we are looking here on a volume that is quite significant. I'm going to just put the circle at the 39.75. 39.75 has a lot of activity over here. Today trade action is 2021 contracts of that. But when we revisit the chart of the S&P, we want to see, does that actually coincides with with the UFOs that we were looking at the SPY. Now, of course, the SPY is a different product. It's 10 times less, and the SPY is currently trading at 39, whatever that was. So here's a 39.66, 39.75 would be somewhere in this area, but it doesn't have any UFOs on the 55 minutes. Let's see if it has anything on the 8. No, I will feel more comfortable bringing it up a little bit higher. So let me just pull in the Thinkorswim platform here quickly. Switch this to the volume. As you can see over here, I'm on the volume, but I also have an open interest. So I have a S&P. I open the 0-day expiration, and I'm going to just quickly here look again at 39.75, 39.75. That's virtually at the money almost, because while I was talking, the market tripped from a 39.66 to 39.71. If I do the 39.75, I'm really taking a chances. And when we looked at the volume, it was at 2,000 and something. Now it already jumped to 9,000. So obviously, this volume is ticking as we are speaking. As we are looking at this, this is constantly increasing. So the highest activity is right here. But notice over here, further away you go, you have a greater activity. 34,000 contracts are at the 4,000. So let's revisit the again chart, see at the 4,000, and I'm going to go on a daily and see what we have here. On a daily, we have a red UFO, but it's all the way up at the 40.44. So let's see if we can do 40.44, if there's any. I would need to add more strike prices here to see 40.44. But the problem is when I add the more strike prices, I don't have any premium left. Well, somebody traded 4,000 today, yeah, but they're probably buying it back because look, what is the price of the 40.44, 40.45 right now? Right now, it's at the 5 cents and the 10 cents. So those are the ones who actually went ahead and sold that bear call a long time ago. So if we cannot do at that level 40.44 for today, could it be that we can then proceed and move further out in time? Yeah, let me just see here if you guys are typing any question. Would you guys be in agreement with me not to push um, daily trade on S&P when liquidity is not an issue? What is the issue? That the volatility has come down. Today they're expecting the move. Today, just today, Mark says, "Okay, go for it." Thank you, Mark. Today they are expecting the move of the S&P 20 points up or 20 points down. So when you look at it, what is the difference between a high and low? Well, here we are at basically 39.80, and over here we're at 39.60. Would you agree that we already had the 20-point move from a low to the high? If you are, then you need to recognize that maybe in this area there's not much trading left for me today, unless I want to start taking chances and be right in front of the freight train, which I shouldn't do. So I would need to go ahead, close this, and see for tomorrow what is the expectation of the market maker that S&P is going to do. And again, I'm using the market maker expectation. This is not my expectation. This is based on a standard deviation. They expect a little bit more, not $20, but more like $37. Well, I still don't see that the $37 is going to have a lot of premium at the level that I would like to fill. And a level that I would like to fill is a 40.45. 40.45. 90 cents with the 70 cents. If I do this, this gives me pathetic 15 cents. I don't think that is worth. And when I want to exit, I need to give them back half of the premium that I'm receiving. Obviously, I'm going to use the word discriminating that one, because you need to recognize that is the correct word. When you're making a trade, you're choosing what is right and what is wrong. And what is wrong, you need to discriminate. So like it doesn't make sense to do it. It just doesn't make sense to do it. So I would need to move further out. So I'm not going to do then the 29, but I can go to Thursday. So I'm doing the Thursday option that says S&P by Thursday can move 50. Now, could there be other reasons why S&P can move 50 by Thursday? Well, let's look at the Forex Factory calendar, because the Forex Factory calendar is going to tell me what are the news that are coming up. So I have a here 28, which already happened. We had some information that came up here, but when I click here to Thursday, we have a final GDP and we have unemployment. So it's on Thursday that they're expecting, the market makers are expecting what I like to call some fireworks. So if you're good with that, I'm going to now consider doing it on Thursday if there's a premium. If there's a premium. So one more time, March 30th is when I'm making a decision to trade. March 30th has 2 days left, not counting today because they already considered that as a 0 day. So I'm opening it up and I'm looking, is there any premium for a 40, 45, 275 to 230? My bare minimum requirement is that I need to get at least 50 cents. 50 cents on a $5, that's a 10%. We're able to get it for 55. Okay. So this is right now paper trading count. This is for educational purposes only. And I'm placing a bear call trade, a bear call spread that it's risking $500 to make the 55. So let's see if we're going to be able to get filled on that. So my order is out there and it's working, but I did not get filled. 275 is what I'm selling, 230 is what I'm buying in terms of the premium. Level is a 440. Why did I pick the level 440? Well, actually, that is just below the zone. Maybe I need to change that. Okay, so I'm going to go and change that because I didn't get filled yet. See, this is my working order. I supposed to get it at the 60, but I didn't. But I'm now going to just cancel it. See if I can move it slightly higher. What do I mean by slightly higher? Well, I want to be actually selling the 40.45. And the reason why I want to sell 40.45, because look at this red UFO. The lower part of that red UFO is exactly at 40.4461. If this is good, please type in okay so I know that you're following. Thank you. Somebody just type in good. I don't have a name on it, but I appreciate you typing this, because if I picked the 40.40, it would be a little lower than that, and I wouldn't feel comfortable with it. You see, when you're looking right here and you bring it up, 40.47 on a 55-minute setup, it says that's where the majority of those unfilled orders are. So what I'm considering now doing is simply selling it right here and then buying the higher strike price, which is 40.50, and that is giving me 45 cents. I'm going to put 50 cents, good for today. So that's going to be only for today, and I'm going to move on to the next one. If the market continues going higher, so when I switched the screen earlier, we were at the 39.66 while I was at the active platform. And in those few minutes when I switched to the toss, it already started lifting to 39.69, 39.70, 39.71. Now it's trading at 39.72. So now I'm patiently waiting for 39.72 to become 39.73. Oh, it just became a 39.73. So obviously the market is what? Moving to the upside. Well, let's prove this in the real time. So I'm bringing back the FinViz. As you can see, I mentioned to you earlier that the sellers have lost what? The upper hand. And now the bulls are pushing. Or at least on S&P. I'm not trading Nasdaq, so it's almost irrelevant, because on a Nasdaq you can come up with the argument that the Nasdaq is still in a downtrend and that we're just about ready to have a third touch, 1, 2, 3, and that the next bar is going to be down, right? However, that's not the case for the S&P, because every one of these 10-minute consecutive bars, it's showing that we are going up, up, and up. So I'm not trading the Nasdaq. I'm trading the S&P, and I'm focusing on it because I believe that I might get filled. Okay, there it is. We already, while I was talking, the market has moved from whatever was the last time when we looked at, I think it was 39.73 to 39.75. And I'm patiently waiting here saying, give me for 50 cents. And I just got filled. Wonderful. I got filled on that. Okay, so let me now take a snapshot of that, put it in the trade active, get that information ready for our spreadsheet here, because I really want to make sure that this is not the only trade that we have placed. So this is the one that we did for the March. For the March. I'm going to now use a trade active platform because I want to make sure that I now just adjust March 31st, same type of trade, and see how much I can get for the March 31st. So what are we doing here? First thing that we are doing here, we are doing the bearish spread that is called bear call spread. I'm going to edit the spread to give me the expiry that I want. And the expiry that I'm desiring is selling. Well, of course, I'll change this from April in a moment, but I want to do the strike prices first. 40.50 is what I bought. 40.45 is what I sold. I got filled on that particular spread. Filled price was at 255, and for the higher unit, which I needed to use as a hedge to save myself, was $1.90. And now I'm gonna just put in what I did over here, which is a March 30th. So that is, it has a 65 cents. It's a bear call spread. It has a 65 cents. So side by side, no confusion, complete understanding of the logic. We have placed on a paper trading platform a bear call spread after examining whether we get something on the March 20th, which is today. We didn't get enough premium. March 29th, we didn't get enough premium. March 30th, there was enough premium. I was hoping to get 50 cents, but because market ripped to the upside, I got what I call the price improvement. So I have received the 65 cents credit. How do we get the 65 cents? I sold the unit that is 40.45 call for 255. That was the naked call. In order for me not to be unprotected, I bought the higher call that is even more out of the money. This higher call over here is, and I'm going to switch the open interest into intrinsic so you would see that it's going to just say 000. It's way out of the money. So over here, we have an at the moneyness here at the 39.75. If I just hide this for a second so I get a little bit more real estate, you would see that I'm all the way up here at 4 to 45. So I'm almost like a 70 points away on a product that is anticipated to move 50 points higher. So if we are right now sitting here at the 39.75 and you add the 50 to it, that's going to be 40.25. So even if we do what the market maker is expecting and rally up 50 points, we should be stopping around this area, 40.25. And where's my bear call spread? Additional 20 points higher. Why did I pick that? Because on a trade active platform, I'm going to just float this for a second so it's not on the way, and I can actually then show you the the level that I saw. I was on a daily when I was evaluating this. I was on the daily when I was evaluating this, and I said this is the area that I'm concerned about. If it comes over there, I don't want to be above. So I'm going to repeat the same transaction, but for March 31st. March 31st happens to be also quarterly, end of the month. I supposed to now know how many points the market maker is expecting that it's going to move for a March 31st. So for March 30th, we already know they're expecting 50. Add one more day, they're just expecting additional 12 points. Well, if they're expecting the 12 points, I'm very sure that I would be able to get more premium on it. The only concern that I have, that volume, it's quite low. Well, the volume is going to come later as the more trades are placed. Volume is going to come. Wow, in this case, what they are doing even the $10 spreads. How do you see that? Well, let's just explain this slowly. This is about $1,000, no, thousand volume. Volume over here is over 1,000, and volume here is over 1,000. Okay, so could it be that they're doing the 40-40 and 40-50? Now, I wouldn't do that one because I don't feel comfortable with the way how this setup is, because that's mean I'm coming below this red unfilled order on S&P. So I will stick to originally what I said I'm going to do, which is just sell the 40-45 and buy the 40-50. So sell one lot, 80 cents. I'm going to ask for 85 cents. I'm going to get greedy. Oh, but you know what? Most likely I won't get it because it's no longer rallying. Notice 39.73. Last time when we checked, this was rallying at the 39.75. What are you talking about? I lost you there. Okay, let me just say this to you. I have drawn this line a few seconds ago saying to you, you have a 3 touches, right? Okay, let me draw a little bit more appropriate. On a NASDAQ, right? 3 touches. Where do you see the 3? Well, this is first, this is second, and this is third. As the NASDAQ is unable to break this small daily downtrend, that is affecting the S&P. But the S&P was so strong. Yeah, S&P is strong. But you have a here this area that represents a big chunk. And that big chunk technology is also one of the sectors of the S&P 500. In fact, if you click on that thing, you're going to get the whole enchilada right here. I'm going to get the whole screen filled up with it. We are trying to go up on the strength in energy. We're trying to go up on the strength in utilities, because utilities is only one besides the energy that has everything green. You cannot make that argument for the healthcare. Majority of the healthcare is, I don't know, kind of black, and black over here means unchanged, unch. There's nothing up more than 3%, except a few little pieces here in the energy sector. So how can we possibly go higher? That's the reason why I'm doing the bear call spread. If you guys understand this, Mark, thank you for confirming it. Just type in like, all right, I get it. It makes sense. So let's not spend too much time debating here, but agree that this is not a bullish market. This market is a market that doesn't know which way to go. If it's gonna go up, we would need to see a lot more buyers coming in, and we just don't see that. We just don't see that. So we are no longer at 39.75. Well, now actually we're lifting a little bit. Now we're on 39.74. Okay, so maybe my order is gonna get filled. You know what? Let me just drop it to 80 cents. I'm gonna drop it to 80 cents. Give me at the 80 cents. I'm gonna be happy if I get for 80 cents. Right at the moment they click, it's no longer going up. Now it's again down to. Okay, you know what? Let's just carry on with our platform here. I'm gonna go again on the chart, option chain. I'm gonna repeat the steps. I'm doing the bearish trade on a S&P for the quarterly, March 31st, in which I am buying the higher unit, which is a 40-50, and selling the lower unit, which is a 40.45. Soon as this gets filled, I will know. Well, you know what? Maybe I'm too greedy. No, I'm not. I actually got filled at 80. So I wasn't too greedy. I got exactly what I wanted. Well, actually, first I wanted 85 cents. That was greediness. And then I got what? What is realistic. And what is realistic is the fact that for a first batch, I had 65 cents. For the second batch, I have 80 cents. So let me just now fill in the numbers. I got filled here at $4.90. Don't I wish I kept all of it? That would be $490 on an investment of $500. That would be wonderful. But then I would be completely naked, and then my margin would be different. We're talking about the margin. Well, what I'm talking about the margin is this. If okay, just one second here. I'm gonna bring the calculator in here. So when I bring the calculator in, it's gonna become very clear how this whole thing works. This strike price is 40.45, but because we need to multiply it by 100, I would need to have in cash this much money, in order to keep all of this $490. Well, I don't get this $490. Well, that's a 4.9 per share, but because each option controls 100 shares, you multiply this. That's how you get it. So people like to multiply this to 490 and smile all the way to the bank. But when they move this decimal, then the spirit drops. Well, what's the best way around it? The best way around it is actually that they simply have a hedge. They receive 490, and 490 is enough for them to buy the 450 call. And this 450 call, it's almost like a free call because you are using out of this 490 $410 to finance it. So now that all that you have online, it's difference. Oh, I don't get that difference. You will get the difference because I'm going to go in the risk graph in a moment, but I just want to make sure that I put this back in over here side by side and discuss which of these two trades is a better trade. So we have individual trades, right? One trade is for the March, one trade is for the quarterly. Over here, I'm getting the credit of the 65 cents. Over here, I'm getting the credit of the 80 cents. But the piece that is missing is this. I'm going to go into the risk graph and I'm going to show it to you. On this one, I have a risk of $420. $420. How do you get the $420? Because I have two strike prices. I have a 40.50 and I have a 40.45. When you subtract that, that's a 5 times 100. That's a 500. They gave me $80. That means I need to keep for a duration of the contract that ends on the March 31st, which is a quarterly, $420. If everything works out, then I'm getting the $80. On the other one, what really happened, that I'm risking more to make less. Let's see if we can squeeze one more in this last 10 minutes. One more. What's the logic? The logic is to go to the April Fool's Day. Well, you can't go to April Fool's Day because that would be the Saturday and April 2nd would be Sunday. But we can open up the April 3rd. So I'm opening up the April 3rd here and I'm discussing the possibility of trading April 3rd. Mark, I'm glad you got filled on the Berkel spread on that price, but I want to now progress with that thing because as long as those unfilled orders are not filled, you can use the same level day after day after day, except the Saturday and Sunday, as I just pointed out. But be aware of it. What market maker expected move is. How did they arrive to this market maker expected move? Well, okay, I'm glad you're asking that. I can just explain it to you. You would look at the at the money option for that particular thing, $39 plus $32. So when you add this thing up, you get about 73. So always add the ask, never add the bid, because the bid is a side that is being sold. Oh, you went a little bit too fast over this. Could you slow down? Okay, sure. Right now, this is about $39. Right now, this is about $32. So when you add these two plus minus, you're going to get this. So always pick at the money strike price of the call at the ask and of the put at the ask and add them. Oh, Josip, I wasn't sure if it's a 39.70 or if it's a 39.75 that I need to add. Okay, so let's add these. Okay, if you add this plus this, are you still getting about the same thing plus minus? So it doesn't matter as long as you are here at the money figuring out. Market maker needs to price these things. And then you're asking, well, they're pricing that in relationship to what? Okay, I'm going to just change a color here so it's going to become more obvious to you when I make this in a red color. In relationship to what's that word here? Intrinsic. Intrinsic. So how much really value does this intrinsic 39.70 has? $3.31. On the put side, check this out. On the put side, nada. So inside of this $73, only $3 is what? A value. And what about the rest of it? Those of you who are present here, Mark, Jeff, what do you think is going to happen with the rest of it in 6 days? It's going to disappear in a thin air. That means it's going to go in the market maker's pocket if they sold it and somebody bought it expecting that everything is good, there's going to be peace all over the world, and market maker is going to keep the difference. So we still want to do the same strike prices, so I need to add 30 or 33 strike prices so I can go up there at 40, 45. Now notice the liquidity is what? Getting smaller and smaller. Why would that be the case? Because these professionals, they know how to invest their money day by day, day by day, day by day. For us putting this right now here, we could have made some money up here at 65 cents. Why do I say 65 cents? Because the next day you can place this one. Of course, that's no longer going to be 80 cents, but let's say by then it's again 65 cents. And then the next time is again, assuming that the S&P is just going sideways, again 65 cents, 65 cents, 65 cents. So they get like, how many times? They get 65 cents. We started on the 30th, they would get it one time, two times. They would get like 120 or $130. While us placing this way out there, we're gonna get only $100. So it's better to have a 100 and what do we calculate? 65 times 2, that's $130 or only $110. Well, this one is safe. Yeah, I know you paid the less commission on it. Let's just fire this thing and see if I'm gonna get filled. See, the market is completely dead. We looked at this about 15 minutes ago and it was sitting here at 39.73. What do you think is happening with the price? It's just going where? Nowhere. Well, it can be that it's almost 9 o'clock in New York. Well, actually, it's noon in New York. It's 9 o'clock here on the Pacific Coast where I am. And the market is just doing nothing. So I don't think I'm going to get that for a $1.10. That would be very nice if I did. Oh, I did. Okay, good. I actually got the price improvement. Oh, you see, you could have done the longer one, or you can have done the, yeah, oh, okay. But be aware of it, that the further away you go in the time, the longer you sit in it. I like to place the trade that I can be in and out in the shortest amount of time. This one, I need to be right for like, what, 6 days. While these, I just need to be right for 2 days or 3 days. And then I can reassess by going back to the chart and seeing on the chart how are the things looking. If the things are not looking good on a chart, I can simply adjust to the different level. What's the next strike price I want? And by then, the volume is going to be guiding me. By then, the volume is going to be guiding me and saying, like, oh, it's going higher and it's going lower. Because obviously, you're looking here, $1.30, 80 cents, 65 cents. That's the best choice. Yeah, but it's the best choice. But don't forget, on a chart, you always have two things, right? And people are all about the price. I'm more about the time. How long do I need to see? How quickly can I have access to that money? That's the biggest thing that I want to ask, when I'm looking at this thing. How quickly can I have access to that money? I'm going to just alter this quickly because everything else looks the same except the filled price. And I have it here, filled price. Imagine this was $8.30. They jack it up on $8.30. But then by the same time, did they jack up the other one? Yeah. The other one's no longer $4.30. It's exactly what? $7. So now when I have this, my outlay of the capital goes to the 370, right? But my profit is also better. My profit is at the $1.30. So when I go it over here, and I'm going to take this time snapshot like that. So for somebody who's paper trading and doesn't know what they're doing, and they just want to place the one single trade they want to place, they probably should be placing this one for April because your maximum risk versus your maximum profit, right? Are two different things. Over here you had 80 cents. Here, let me just put this. So over here you had the 80 cents while you're risking what? 420, right? So just be aware of it, how this whole thing works. Okay, I need to now start wrapping it up and going over everything that we did. We looked at the chart of the S&P 500 and we saw where the red UFO was. Okay, we said there's a huge order of the sell orders that hasn't been filled. Lower part of that is 40.44. So we rounded up to 40.45 and we used that as a line in the sand. Just like when we started the session, right? I gave you the agenda for today, and that agenda for today considered the monthly. And on a monthly, did I have one line on the sand? Yes. And I was looking based on that line on the sand, I can't make any decision. I need to dig deeper. I dig deeper into the what? Sectors. I think the sectors are down here. I'm going to just cut this and put it where it should be, which means that the sectors are right here. So it showed that XLK is slightly above, but it shows that financial is below. So you have one is up, one is down, 50-50. You don't know which way it's going to go. At that point, we start looking at the individual trades and we concluded that we shouldn't be placing any bullish bets. We felt more comfortable with bearish bets. The bearish bets on S&P, which is a mother of all products, because the S&P 500 is so liquid. We decided that based on this level, we can do it. So, ladies and gentlemen, if you don't have any questions, thank you for your interaction and I wish you good luck. And make sure that you always stay hedged. Always stay hedged. Don't ever sell the naked call. Always have a one above it that it's going to protect you if you're doing the bear call side. I wish you all the best and have a good day. Goodbye.